On October 23, 2024, something happened in the bond market that should have stopped the world, but most people missed it completely. The US Treasury held a 20-year bond auction. These are long-term government bonds that America sells to fund its operations. This particular auction needed to raise $16 billion. It failed. Not partially. Not poorly. It failed. The bid-to-cover ratio, the measure of demand, came in at 2.24, the lowest in years. But here's what made it unprecedented. Foreign buyers didn't show up. Primary dealers, the banks forced to buy unsold bonds, had to absorb massive amounts at yields they didn't want. For the first time in modern history, the world's safest asset had no buyers. This wasn't just a bad auction. This was the Ponzi scheme reaching its mathematical endpoint. Because US Treasury bonds aren't investments, they're the final stage of a 240-year debt pyramid that's now collapsing under its own weight. Here's what most people don't understand. America's Treasury market isn't backed by economic strength. It's backed by a promise to pay future debt with more debt. It's the oldest, largest, most sophisticated Ponzi scheme in human history. And it's worked for 240 years because each generation of creditors was paid with money borrowed from the next generation. But we've reached the point where there is no next generation of creditors. The buyers are gone. The pyramid is collapsing. And when the Treasury market breaks completely, not if, when the entire dollar system breaks with it. This is the most important financial story of our lifetimes. And almost no one sees it coming. Let me show you the 6-stage Ponzi collapse pattern that destroys every debt pyramid in history. Where the Treasury market is right now in that pattern. Why the October 2024 auction was the Lehman moment for sovereign debt. Who holds $36 trillion in worthless promises. And what happens when the largest Ponzi scheme in history finally collapses. Because this isn't a financial crisis. This is the end of a 240-year illusion. Before I show you the 6 stages of collapse, you need to understand what Treasury bonds actually are and why they're a Ponzi scheme. A Ponzi scheme works like this. An operator promises investors high returns. Early investors are paid with money from new investors. As long as new investors keep coming, the scheme works. When new investors stop coming, the scheme collapses because there's no real underlying value, only the flow of new money. US Treasury bonds work the same way. The US government spends more than it collects in taxes, $2 trillion more per year. To cover this deficit, it sells bonds. A bond is a promise. Give us $1,000 today, we'll pay you back $1,000 plus interest in 10, 20, or 30 years. But where does the government get the money to pay back those bonds when they mature? It sells new bonds. When a $1 trillion batch of bonds matures in 2025, the Treasury doesn't pay them back with tax revenue. It pays them back by selling $1 trillion in new bonds to new buyers. The old bondholders get paid. The new bondholders become the bag holders. This is definitionally a Ponzi scheme. Early creditors are paid with money from later creditors. There's no underlying asset-generating returns, only the continuous flow of new debt. The scheme has worked for 240 years because of 3 structural advantages. First, the dollar is the reserve currency. Every country needs dollars for international trade. To get dollars, they buy Treasury bonds. This created a captive buyer base. China, Japan, Saudi Arabia, they had to hold treasuries because they needed dollar reserves. Second, America had the strongest economy. For most of the 20th century, U.S. GDP growth supported the debt. If the economy grows 3% and debt grows 2%, the debt is sustainable. Tax revenues eventually catch up. Third, the Federal Reserve could print money to buy bonds. When foreign buyers slowed down, the Fed stepped in as buyer of last resort. Quantitative easing, printing money to buy treasuries, kept the scheme alive during 2008 and 2020. These 3 pillars held the Ponzi scheme together. But all 3 are collapsing simultaneously right now. Every Ponzi scheme starts with early success. Returns are high. Confidence is total. The system becomes embedded in the financial structure. Everyone depends on it. Treasury bonds from 1790 to 1971 were backed by real assets, gold. Under the gold standard, dollars were convertible to gold at a fixed rate. Bonds were claims on actual wealth. This wasn't a Ponzi yet. It was legitimate lending. But in 1971, Nixon ended gold convertibility. Dollars and treasuries were no longer backed by anything except the promise to pay with future dollars. This is when the Ponzi began. From 1971 to 2000, the scheme worked perfectly. U.S. debt grew from $400 billion, 1971, to $5.7 trillion, 2000. But GDP grew even faster. The economy was strong. Foreign buyers Japan, Europe, oil exporters needed dollars and bought treasuries willingly. During this phase, treasury bonds became structurally embedded in the global financial system. Central banks worldwide held treasuries as reserves. By 2000, foreign holdings reached $1 trillion. Banks used treasuries as collateral. The entire repo market $4 trillion daily depends on treasuries as pristine collateral. Pension funds and insurance companies bought treasuries for safety. Regulations required risk-free assets. Treasuries were legally defined as risk-free. Money market funds parked cash in treasuries. $6 trillion in money markets holds mostly treasuries. By 2000, the treasury market wasn't just a government funding mechanism, it was the foundation of the global financial system. Everyone depended on it. This is what makes the collapse so dangerous. When treasuries fail, everything built on top of them fails. Stage 1 established structural dependency. But dependency creates vulnerability. Every Ponzi scheme reaches a phase where growth becomes exponential. The operator must borrow more and more to pay earlier creditors. Warning signs appear: growth rates unsustainable, new investors harder to find. But the operator and participants ignore the warnings because stopping means collapse. U.S. debt growth became exponential after 2000. 2000. $5.7 trillion. 2008. $10 trillion, financial crisis bailouts. 2020. $23 trillion, COVID stimulus. 2024. $36 trillion. In 24 years, debt increased 6.3x. But GDP only increased 2.5x. The debt grew faster than the economy that's supposed to support it. This is the mathematical signature of a Ponzi scheme. Exponential growth of liabilities without proportional growth in productive assets. The warnings were everywhere. Warning 1. Interest costs exploding. In 2020, interest on the debt was $345 billion. In 2024, it's $1.2 trillion. More than the defense budget. Interest costs are now the second largest federal expense after Social Security. Warning 2. Debt to GDP ratio hit 120%. Historically, when sovereign debt exceeds 90% of GDP, economic growth slows. At 120%, you're in crisis territory. Only Japan has sustained higher ratios, and Japan's been stagnant for 30 years. Warning 3. Foreign buyers slowing. China's treasury holdings peaked at $1.3 trillion in 2013. By 2024, they're down to $775 billion. Japan's holdings peaked at $1.3 trillion in 2021, now $1.1 trillion. Foreign buyers are exiting. Warning 4. Fed trapped. The Fed held $4.5 trillion in treasuries after QE. When they tried to reduce holdings in 2022 to 2023, quantitative tightening, bond yields spiked and regional banks collapsed. The Fed can't exit without crashing the market. Every economist knew these warnings meant the debt was unsustainable. But stopping means admitting the system is broken. Politicians ignored it. Central bankers ignored it. Investors ignored it. Because in a Ponzi scheme, everyone profits as long as it keeps going. Admitting it's unsustainable means triggering collapse. Stage 2 saw exponential growth and ignored warnings. But ignoring math doesn't change math. Every Ponzi scheme hits a stage where finding new investors becomes difficult. The operator must offer higher returns to attract money. But higher returns mean faster growth of liabilities. The scheme accelerates toward collapse. The treasury market hit this stage in 2022 to 2024. 2022. The Fed raised interest rates from 0% to 5.5%. This was supposed to fight inflation, but it had a catastrophic side effect. It made treasuries unattractive. Here's why. If you bought a 10-year treasury in 2020 at 0.5% yield, and rates rise to 4.5% by 2023, your bond loses value. Who wants a bond paying 0.5% when new bonds pay 4.5%? The answer: nobody. Existing bondholders tried to sell, but there were no buyers. Bond prices collapsed. This created $1.7 trillion in unrealized losses across U.S. banks. Losses that triggered Silicon Valley Bank's failure in March 2023. 2023, regional bank crisis exposed Treasury vulnerability. SVB held $120 billion in treasuries and mortgage-backed securities. When rates rose, those bonds lost value. SVB tried to sell at a loss. Depositors panicked. Bank run. Collapse. 3 more banks failed the same way. Signature, First Republic, Silvergate. The Treasury market, supposedly the safest in the world, had triggered a banking crisis. 2024. Foreign buyers accelerating exit. China reduced holdings by $200 billion in 2 years. Saudi Arabia diversified reserves into yuan and gold. Even Japan, America's most loyal creditor, reduced holdings. Why? Because the returns don't justify the risk anymore. Treasuries pay 4 to 5%, but inflation is 3 to 4%. Real returns are barely positive. Meanwhile, the dollar's reserve status is declining. Why hold dollar bonds if the dollar itself is losing dominance? The Treasury needed to find new buyers. So it did what all Ponzi schemes do in late stages. Offered higher returns. Yields on 10-year treasuries went from 0.5% 2020 to 5% 2023. A 10x increase in just 3 years. This attracted some buyers. But it also made the debt more expensive. At $36 trillion in debt, every 1% increase in average interest rates costs an additional $360 billion per year. Rates have gone up 4%. That's $1.44 trillion in additional annual interest costs. The scheme needs $2 trillion in new borrowing per year just to function. But it also needs to pay $1.2 trillion in interest. So actually, it needs $3.2 trillion in new buyers annually. Where does $3.2 trillion per year in new Treasury demand come from? It doesn't. That's why we've reached stage 3. Every Ponzi scheme, when it can't find legitimate new investors, turns to fraud. The operator creates fake demand, manipulates markets, or uses accounting tricks to hide the collapse. The US Treasury and Federal Reserve have used multiple fraudulent mechanisms to sustain the scheme. Fraud 1. Quantitative easing, money printing. From 2008 to 2022, the Fed printed $4.5 trillion and bought treasuries. This created fake demand. The Fed isn't a real investor. It's the government buying its own debt with newly printed money. This is illegal for individuals. If you write yourself a check for $1 million, deposit it, and call it income, that's fraud. But when the Fed does it, buys treasuries with printed money, it's called monetary policy. It's fraud. It's the operator buying their own Ponzi shares to fake demand. Fraud 2. Accounting gimmicks with extraordinary measures. When the U.S. hits the debt ceiling, the Treasury uses extraordinary measures to keep borrowing. They shuffle money between government accounts, suspend pension investments, and delay payments. This isn't emergency management. This is routine. The debt ceiling has been raised 78 times since 1960. Extraordinary measures are now ordinary. They're accounting fraud to hide the fact that the government is bankrupt. Fraud 3. Suppressing yields through intervention. In March 2020, Treasury yields spiked as investors panicked. The Fed stepped in and bought $1 trillion in treasuries in 3 weeks. This forced yields back down. In 2023, when yields spiked again, the Fed created the Bank Term Funding Program, BTFP, a backdoor way to support banks holding underwater treasuries. Every time the market tries to price treasuries at their true risk level, the Fed intervenes to suppress yields artificially. This is market manipulation. It's fraud. Fraud 4. Japan's proxy buying. Japan holds $1.1 trillion in treasuries. But Japan's own debt to GDP is 260%, the highest in the world. Japan can't afford to hold treasuries. They hold them because the US pressures them to. This is a coordinated scheme. America borrows from Japan. Japan prints yen to buy treasuries. Both governments pretend this is normal. It's not. It's two insolvent governments propping each other up. Stage 4 revealed the fraud. The treasury market is only functioning because of manipulation, money printing, and coordinated intervention. When that stops, the collapse accelerates. Every Ponzi scheme reaches a stage where cracks become visible. Payments are delayed. Returns drop. Investors start asking questions. Withdrawals increase. The operator becomes desperate. The treasury market is in stage 5 right now. The cracks are everywhere. Crack 1. Failed auctions. October 2024's 20-year bond auction had the lowest demand in years. February 2024's 30-year auction saw yields spike mid-auction, a sign of no buyers. Failed auctions mean the market is rejecting US debt at current prices. Buyers want higher yields or they won't participate. Crack 2. Primary dealers forced to absorb unprecedented amounts. Primary dealers are banks contractually obligated to buy unsold treasuries. In 2024, dealers absorbed 15 to 20% of auction volumes, double the normal rate. This means the free market isn't buying. Banks are being forced to hold bonds they don't want, at yields that don't compensate for risk. Crack 3. Repo market stress. The repo market is where banks borrow overnight using treasuries as collateral. In September 2019, repo rates spiked from 2% to 10% in one day. The Fed had to inject $75 billion to prevent collapse. In 2023, repo stress returned. The market that's supposed to be the most liquid in the world is seizing up repeatedly. Crack 4. Treasury volatility hitting record levels. The MOVE Index measures bond market volatility. In 2024, it hit levels only seen during 2008 and 2020 crises. Treasury bonds, supposedly the safest asset, are now as volatile as stocks. Crack 5. Yield curve inversion. The yield curve has been inverted, short-term rates higher than long-term rates, for over a year. This signals that investors expect crisis. They'd rather hold short-term bonds than lock into long-term bonds because they don't trust the long-term solvency of the US government. These cracks aren't isolated incidents. They're systemic stress signals. The treasury market is breaking in real time. Every Ponzi scheme ends the same way. One day, withdrawals exceed new investments. The operator can't pay. Panic spreads. Everyone rushes to exit. The scheme collapses instantly. And because the scheme was embedded in the financial system, contagion destroys everything connected to it. The treasury market hasn't reached stage 6 yet. But it's coming. Here's what it will look like. Phase 1. A major treasury auction fails completely. Not just weak demand, zero demand. The US Treasury offers 10-year bonds at 5% yield. Nobody bids. The auction fails to raise the needed funds. This has never happened in modern history. When it does, it signals to the world, US debt is no longer safe. Phase 2. Foreign holders dump treasuries. China, Japan, Saudi Arabia, and other foreign holders see the failed auction. They realize their $7.5 trillion in treasury holdings might become worthless. They try to sell before everyone else. But there are no buyers. They dump at any price. Treasury prices collapse. Yields spike to 8%, 10%, 12%. Phase 3. The Fed prints money to buy treasuries. With no private buyers, the Fed steps in. They announce unlimited QE. They'll buy any amount of treasuries to prevent collapse. But printing trillions to buy treasuries is hyperinflationary. The dollar crashes. Foreign holders dump even faster because their dollar holdings are losing value daily. Phase 4. Repo market freezes. Banks holding treasuries as collateral can't borrow overnight because nobody trusts treasury collateral anymore. The repo market, $4 trillion daily, freezes. Without repo, banks can't fund daily operations. Regional banks fail. Major banks face liquidity crises. Phase 5. Money market funds break the buck. Money market funds hold $6 trillion, mostly in treasuries. When treasury prices collapse, money market funds' net asset value falls below $1. This triggers massive redemptions. Funds freeze withdrawals. $6 trillion in what Americans thought was cash becomes illiquid. Phase 6. Pension funds collapse. State pension funds hold $4.5 trillion, heavily invested in treasuries. When treasuries collapse, pensions become insolvent. Retirees' income disappears. Phase 7. Dollar loses reserve currency status. With treasuries worthless and the Fed printing hyperinflationary amounts, the world abandons the dollar. Oil exporters refuse dollars. Trade shifts to yuan, euros, gold. The dollar crashes 50 to 70% against other currencies. Imports become unaffordable. Americans' standard of living collapses. This is stage 6. This is what happens when a 240-year Ponzi scheme finally ends. Ponzi schemes collapse on one of two timelines: slow bleed or sudden implosion. Slow bleed. New investors dry up gradually. The operator struggles for 5 to 10 years, constantly on the edge. Each crisis is barely managed. Eventually, one crisis is too big to manage. Collapse. Sudden implosion. A triggering event, scandal, failed payment, mass withdrawal, causes instant panic. Collapse happens in days or weeks. The Treasury market is on the slow bleed timeline right now, but approaching sudden implosion. Here's the timeline based on current trajectory. 2024 to 2025. Continued stress. More weak auctions. Foreign buyers continue exiting. Primary dealers absorb more unsold bonds. The Fed tries to maintain stability but can't reduce its Treasury holdings without crashing the market. 2025 to 2027. A triggering event. Possible triggers include a major geopolitical crisis, Taiwan, Middle East, that spooks investors. A debt ceiling standoff where Congress refuses to raise the limit. A credit rating downgrade from AAA to AA, already happened with Fitch, but if Moody's downgrades, panic ensues. Japan or China dumping $500+ billion in treasuries suddenly. A major bank failure due to treasury losses. Any of these could trigger stage 6. 2027 to 2030. Collapse acceleration. After the trigger, the Fed prints massively to prevent collapse. This causes dollar devaluation. Inflation returns. Foreign holders accelerate exits. Treasury yields spike despite Fed buying. The government faces impossible choices. Cut spending by $2 trillion, politically impossible. Riots, government shutdown. Raise taxes by $2 trillion, economically impossible. Would crash economy. Print $3+ trillion per year, hyperinflation. Dollar becomes worthless. All options lead to collapse. 2030 to 2035. Post-collapse adjustment. The dollar loses reserve status. Treasury market shrinks to a fraction of its current size. America can only borrow what it can actually repay. Maybe $5 to $10 trillion total debt, not $36 trillion. This requires default on $25+ trillion in debt. Bondholders, foreign governments, pension funds, retirees lose everything. This is the cost of a 240-year Ponzi scheme ending. Let me show you exactly who profits and who gets destroyed when the Treasury Ponzi collapses. The winners are: gold holders win massively. When treasuries collapse, investors flee to the only asset with no counterparty risk. Gold surges from $2,000 per oz to $10,000 plus. Anyone holding physical gold multiplies their wealth 5x. Commodity holders win. Oil, copper, agricultural land, silver. All real assets that can't be printed or defaulted on. As the dollar collapses, commodity prices in dollar terms explode. Countries with low debt win. Singapore, Switzerland, Norway. Nations with strong balance sheets become safe havens. Their currencies and bonds replace treasuries as safe assets. BRICS nations win geopolitically. China, Russia, India, Brazil, they've been diversifying away from treasuries for years. When the collapse happens, they're positioned as alternatives to the dollar system. The yuan and gold-backed currencies gain reserve status. Debtors with fixed-rate dollar loans win. If you owe $500,000 on a fixed-rate mortgage and the dollar loses 50% of its value, your real debt burden just halved. Inflation erases debt. And the losers are. Treasury holders lose everything. $36 trillion in treasury bonds become partially or fully worthless. This includes foreign governments, $7.5 trillion losses, China, Japan, Saudi Arabia. US pension funds, $4.5 trillion losses, state pensions, corporate pensions, retirees get nothing. Insurance companies, $2 trillion losses, life insurance policies, annuities, can't pay claims. Banks, $5 trillion losses, bank balance sheets collapse. Massive bank failures. Individual investors, $1 trillion losses, retirees holding bonds in IRAs, 401ks. Dollar savers lose 50 to 70% purchasing power. Anyone holding cash, dollar bank accounts, money market funds, loses half their wealth as the dollar devalues. Americans on fixed incomes lose. Social Security, pensions, fixed annuities, these are paid in dollars. When the dollar collapses, the nominal payment stays the same, but it buys 50 to 70% less. Retirees' standard of living collapses. U.S. government loses ability to function. With no ability to borrow, the government must balance the budget immediately. This means cutting $2 trillion from a $6 trillion budget. Social Security, Medicare, defense, everything gets cut 30 to 40%. American living standards collapse. For 50 years, America has lived beyond its means by borrowing from the future. When borrowing stops, living standards fall to match actual economic output. That means 30 to 40% decline in consumption. Fewer imported goods. Higher prices. Lower wages relative to global standards. The wealth transfer from treasury holders to hard asset holders will be the largest in history. $20+ trillion shifting from paper promises to physical reality. Let me end with this. The US Treasury market is not an investment market. It's a Ponzi scheme that's lasted 240 years, longer than any Ponzi in history, because it had structural advantages that no other Ponzi ever had. The dollar was the reserve currency. America was the strongest economy. The Fed could print money to cover shortfalls. But all three advantages are ending simultaneously. The dollar's reserve share is falling from 71%, 1999, to 58%, 2024. Foreign buyers are exiting. The Fed can't print without causing hyperinflation. The October 2024 bond auction wasn't just a weak auction. It was the Lehman Brothers moment for the Treasury market. It was the day the world said, "We're not buying your debt anymore." And once that signal is sent, the Ponzi collapses. The timeline based on Ponzi collapse patterns and current stress signals says we have 3 to 7 years before complete collapse. Not gradual decline. Sudden implosion. When it happens, $36 trillion in bonds become worthless. Pension funds collapse. Banks fail. The dollar crashes. American living standards fall 30 to 40%. This is the cost of running a 240-year Ponzi scheme. Every Ponzi ends the same way. Early participants are paid with money from later participants. Eventually, there are no more later participants. We've reached that moment. The Treasury market just broke. The 240-year Ponzi scheme is ending. And everyone holding paper promises is about to discover what happens when the music stops. If this documentary showed you that Treasury bonds are a Ponzi scheme and collapse is inevitable, then you need to subscribe, because over the next few years, I'll track every stage of this collapse. Every failed auction. Every foreign sell-off. Every desperate Fed intervention. Every sign that stage 6, total collapse, is imminent. The Treasury market just broke. The Ponzi scheme is ending. History's largest debt pyramid is collapsing in real time. Position accordingly. If you learn something new today, smash that like button like it's the great firewall, and hit subscribe so you don't miss the next one. Thanks for watching. Stay curious. And remember, the best way to predict the future is to understand who's writing the rules.